Hello guys, welcome back to my YouTube channel. This is your boy TradeMate. Sorry the video has delayed for quite some time prior to the previous upload that I made in regards to the series that I'm doing. I said it's going to cover market structure, supply and demand, and then inducement or liquidity. And this is basically everything that you need to be profitable in the year 2025. All right, so in the previous video we covered market structure, but in today's episode I am going to cover two topics at the same time. I'm going to cover inducement and supply and demand. Right, so we need to understand that when it comes to every trading strategy, there are basically three components that forms your trading strategy. The first is structure, which is market directionality. Basically what this means is that we use structure to predict or anticipate where price is likely to go in the near future. And then the next is location. So the location is basically where do you engage with price, and that is where your supply and demand zone comes in. So this will be our supply and demand zones. And the next thing we also look at is confirmation. So how do you confirm that price is going to react or accept the zone that you have determined using any other approach to determine your supply and demand? So this can be any other way of confirmation. It can be candlesticks, pattern, or it could be order flow like footprint or something, if you know how to use order flow tools like I've been doing to confirm my trade. Right, so basically if you are able to get a system that covers these three major things, then you are on the good side. Now when it comes to inducement and then liquidity, it's just an addition. Inducement and liquidity is part of structure. It's just that complex moves within market structure that kind of induce traders to take early trades, and then later the market reverses back to their stop losses before it moves in their direction. All right, so without wasting much time, let's look at an overview of what we covered in the previous video. So in the previous video we looked at market structure, and then we said we have an uptrend where price basically creates high highs, high lows, high highs, high lows, and then on a downtrend you see price getting lower lows, lower lows, lower high, lower low, lower high, lower low, lower high. In that regard, breaking structure. So anytime price creates a new low, what happens is that this structure point, it is broken, and that's what they call break of structure. So if you don't know what break of structure is, it is simply as that. For example, price in this uptrend creating higher highs, high lows, higher highs, high lows. If this structure point that was put in before the pullback to put in another higher low, if price further goes to create a new high, then this previous high that was broken, we call this activity break of structure. Simply BS. Okay, so we call this break of structure. So when you see price breaking structures to the upside, then that is an uptrend, and the other way is a downtrend. So in a nutshell, that is all you need to know about structure. Yes, of course, this is a textbook way, but in reality you see price creating complex structures, like you see creating high highs, and before price putting the low, you can do this. Before doing this, even this, price can do something like this. Now in reality, this is how structure looks like. It's not that straightforward like I have previously drawn over here. So all you need to understand is that anything that is happening within the main swing point. And if I talk about a swing point, I'm talking about the main price level where price really turned. Okay, so this is a swing high, this is a swing low, this is a swing high, this is a swing low. So the ranges between the swing high and the swing low is the intermediate trend. So what that means is that, assuming this is a high time frame, is what we are looking at. Assuming this is a 1 hour chart, okay? Assuming this is a 1 hour chart. Now, if this is a 1 hour chart, then this intermediate movement upon price pulling back to create the new swing low can be a shorter time frame trend. Let's say 5 minutes. It can be a 5 minute downtrend. So if you don't understand what is happening on the high time frame perspective, you might think that what price is doing over here is basically the trend, and then you might be shorting. And if you are not aware of a possible zone within the high time frame that price will reverse by creating the swing low and then continue the momentum up to the upside on the 1 hour time frame, in this case as our example, then you might likely be on the side where price will literally kick you out. So you need to be aware of what is happening on the high time frame before you can be profitable trading the lower time frame. All right, so don't just jump on the chart and then go to 5 minutes and then start clicking your buy or sell. You need to understand what the high time frame is doing. If the 1 hour is your entry time frame, then you need to check out the high time frame, let's say 4 hour and above. 4 hour and above. If your entry is 1 hour, then you need to start doing your analysis at least from a high time frame. I would prefer daily. If my entry is 1 hour, jump to 4 hour to look at what is happening after the daily, then I'll later come back to 1 hour. So basically, I will do a video and talk about time frame synchronization. I think I covered a bit in the previous video, but you need to understand how the time frames work. Basically, they do the same thing. There are just few tricks that you need to understand when it comes to the differences between the time frame. Price is fractal in nature, so if what happens on the higher time frames, the same thing happens on the lower time frames. You just have to understand when a pullback is ending, because a pullback is basically a shorter term trend in the lower time frame. All right, so now having said that, let's quickly look at how to draw our demand and supply zones, and then let's see. All right, so now what is a demand and then what is a supply? Now the market basically moves based on demand and then based on supply. A demand zone is basically a zone where price consolidated a bit before a push up. Now you need to understand that price always moves from a balance zone to balance. Okay, so when price is consolidating, price is actually in a balance zone, and then when it finally goes on distribution, it is seeking another balance. Okay, so price will create another value before pushing up. So now when you see something like this is basically where the demand is. Okay, this is basically where the demand is. If you trade auction market theory or order flow, then you'll be able to see. If you use the volume profile, you'll see this is where the volume is. All right, so market is really moved by liquidity. So this is what it means when we talk about liquidity. Liquidity simply means orders. Okay, so before price makes a move, it needs to make orders. Buyers and sellers need to trade on a fair price. So this range is basically considered as a fair price. If price goes up like this, nobody wants to trade. No buyer wants to buy at a high. Buyers want to buy at a low. Okay, and then sellers want to sell at a high. So when they are dealing within a range, they consider it as a fair price. They consider it as a fair price. Now, if they break out of the range and they are on a distribution phase, trying to seek another balance zone up somewhere, if there's no balance zone out there to enter, then probably what they are going to do is that they are going to build value themselves, accumulate volume before they continue the momentum up. Or if this accumulation, sellers are stronger than buyers, then obviously they are going to take a turn and then seek this previous balance. And so this is auction market theory. It's another video that I'll do in detail, but if you understand the basics of this, then you know basically how demand and supply zone works. So this is how the market moves in a nutshell. Now, the opposite is a supply way. If this is a downtrend, so this that I've drawn here is the upside. Now, what we are normally used to, or what we see in most YouTube videos, is that they tell you that the demand zone in this case is the last bullish candle or the last bearish candle before what? The push to the upside. But trust me, the color of the candle doesn't matter. It is, if you are not using order flow, volume profile, market profile, or any other institutional tool to determine your supply and demand zones, and you are relying purely on candlesticks, then the color of the candle doesn't matter. What you need to understand is that the last candle, okay, the last candle before the push or before an imbalance is created. Now, I'll show you what an imbalance simply is. So an imbalance is simply a 3 candle range. We have where the open and the close of the first doesn't surpass the middle candle. So you realize that we have this wick over here, then we have this wick over here. So in that case, the imbalance zone is like this, because you realize that the wick of the first candle and the third candle doesn't really come out like this. Okay, it doesn't cover the full body of the middle candle, so there's a gap. So this gap is what we call the imbalance. Some call it fair value gap. The name doesn't matter, but it's the same concept. Now, so if you want to determine your demand zone basically is the last candle before the imbalance was created. The imbalance simply represents momentum. Now, this is very important because when price is seeking balance elsewhere after a time of accumulation has taken place, the participant that win the auction within the balance zone, if a large institution is involved, they go with huge momentum. You understand? So that momentum is what creates the imbalance. And using candlesticks, the imbalance is a key indicator to determining correct demand zones and supply zones. So if I should flip the chart, this is the case also for a supply zone. All right. So in that case, if price is returning back in the future, we will consider somewhere this zone as supply. Now, the reason is because we had this imbalance that was created right after the push down. So this movement to the downside, showing momentum, broke multiple structures over here. So now the last candle to the upside before the push down, or the last candle, whether it is blue or red, whether it is a buy candle or a sell candle, the last candle before the momentum is created becomes your what? Your supply zone. So this is where you engage in for a sell, and for a demand zone, this is where you engage in for a buy. So now, having understand that, let's quickly go to the chart and then let me show you a couple of examples. Now, over here on the 50-minute chart, Euro USD, of course, this is cherry picked, but this is basically what happens in real market. So yeah, I'm not basically doing anything to impress anybody. Just go and back test it yourself, and then you will see the effectiveness of what I'm teaching you over here. Now, if we look at Euro USD for some days now, basically starting from a week, the whole week from Monday, you can see that price was basically in a huge downtrend. We were sort of consolidating within this range on the 50-minute time frame. Let's start from 1 hour to see. So on the 1 hour, you see that we are coming straight. We're moving straight to the downside, and then what happened was that we sort of changed direction to the upside when price took out this major swing high. All right, now some will consider this as the change of character, whatever be the case. I will consider this as the true change of character, because this is a proper swing high. All right, now when this was taken, then this can be considered as what? As a change of character. Now if we go back to, you see that we came back, pulled back to what? To the origin of the main swing low that created multiple internal structures and finally took out the swing high. So this is the origin, and then this is what? The demand zone, and then price tapped into it. So this becomes your break of structure. This becomes your break of structure, right? And then this is your demand zone. If I zoom out very well, you will see that, like I said, the color of the candle doesn't really matter. You see, we have a buy, we have a sell candle, and we have a buy candle. The color doesn't really matter. What matters is selecting the last candle, and then if you stretch it out, this is where price reacted to, okay, before the push to the upside. Now let's look at it from 50-minute time frame. All right, so because if we are going to day trade, we need to look at least 15-minute time frame. On a 1 hour time frame, our trade will basically take a bit longer, depending on the kind of trader you are. Now the same concept works for swing trading, at the same time works for what do you call it, an intraday or scalping. Now, so having established that we've taken a major swing high, and then our price is creating higher highs, higher lows to the upside on the 50-minute, let's look at recent price action. Now on recent price action, we can see that we've taken out what? A high over here. Now let's look at the price movement within this leg. Now you can see that the movement to take this high and led to this break of structure point, there were some imbalances. Okay, there was some momentum that was displayed. If I should zoom out well, you'll see that we have this imbalance over here, we have this one over here as well. And I told you that when it comes to imbalance, you see that this is candle number 1, this is candle number 2, and this is candle number 3. Okay, now you can see that the high of this candle is here, and then the low of this candle is here. So do you see there's a gap? Because the low of this candle and the high of this candle did not basically cover the entire range or body of the second candle, which is the middle one. So this gap is a momentum. It shows momentum. It shows the strength of the demand or the buyer that was sitting within this range. So this is very important to determine the demand zone. Now, having seen this, then we pick our what? The last candle that before the momentum was created. So this is the demand zone, not really the color, because if you look at the color, then like what some YouTubers teach, then you are going to select this whole sell candle before the momentum to the upside. Now, if you pick the last candle, irrespective of the color, sometimes what happens is that you're going to make some trade, but trust me, that has a high win rate. And of course, there is no strategy that is 100%. All right, so but this is the best way to do it. You can backtest it and then you see this is the best way to do it. So if we play price forward, you will see that price eventually came to the zone. All right, so basically this is the current price action. So I think we picked the wrong range. Let's do this one over here, because the same concept is over here as well. Now we have this break of structure to the upside. Okay, then we have two possible demand zones, because we have imbalance here. So we have these two possible demand zone. Then we also have this one over here as well. So now let's see This is where confirmation is very important, because if you have multiple zones like this, then you need to wait to see how price is going to react at each zone. And if your confirmation gives you the signal that it is respecting this one to the upside, then this has to what take place. Then you need to enter from here. But what I basically do most of the time is that I go for the demand zones or supply zones that is below 50%, because this range, the red line marks 50% of the range. So normally I prefer the extreme demand or supply zone, because these have a high win rate, unless there's a liquidity protecting the demand zone, or there's an inducement, protecting the demand zone or the supply zone. So I'll cover inducement after we look at some examples with the supply and the demand zone selection or determination. Then I will now show you what inducement is. Right, so if we play price forward, you see that price basically came all the way to this zone, and oh yeah, we missed another one. We have another imbalance here, so this is also a demand zone. All right, so now we came to this one and this was not respected. Okay, so this becoming violated, and then our entry comes over here. You see how this candle was wicked, so you can enter at the close of that candle, put your stop loss here at the low of that candle, then possibly target the high. And if you should play price forward, you see that was a quick 4:3 reward. Of course, this was cherry picked, or this was picked in hindsight, or whatever you call it. So yeah, but basically this is it. So you see that this demand zone also had imbalance. Okay, and then this one also had imbalance, so price could have come to this one as well, and this also had imbalance. Right now, the most important thing is the demand zone that led to the break of structure is what is important. Now, what do I mean by that? If I replay price back here to this zone, all right, now the true demand zone or supply zone must also break the recent structure. So if we look at this one, we see that price was creating what? Lower high, lower lows, and then we went to the upside. Now, when we're reversing, this demand zone couldn't take even the supply. Okay, couldn't even take this structure high. And then we put in another consolidation. Now, if you want to know this is a consolidation, like I showed you earlier on, before a demand zone and supply zone is formed, there must be some form of consolidation. When you go in 5 minutes, you see that zone is a sort of consolidation. You see, we have price stalling within the same range, 1, 2, 3, 4, 5 candles within the same range. So this demand zone really led to the break of structure, and of course you can clearly see the momentum. You see these huge imbalances that were formed. Even this guy on the 5 minute, we cannot see any imbalance validating this zone. So that means that on the 5 minutes becomes our demand zone extreme, right? But this demand zone couldn't break structure. It is this one that broke this structure, and then the main swing high that is over here. So on the 50 minute, that will be your entry time frame, or even if you decide to take your entry time frame on the 5 minute, it is still the same because price is fractal in nature. So this demand zone truly broke the structure high. This demand zone truly broke the structure high. So this become more valid than this. And then we have inducement protecting it. Now, I'm not pointing at the inducement because I've not tackled inducement. So after that, I'm going to tackle inducement also in this video. And then we come back to the same example to see what the inducement is. Now, if this really broke the structure high, then it means that this is our demand zone that we need to focus on. And of course, that's where price came quickly and then tap into it before it went to the upside. Now, the same way for supply zone. So let's do this. Now you realize that this is the swing low, put in a high, tapped into this breakup block or this origin over here, broke the structure low again, we had the imbalance created, multiple imbalances created over here too. Then we have this minor breakup structure, but then the main swing low over here was broken by this supply guy here. So this guy is the true supply because he had the momentum to break the low, not this one. This one, before this one was created, the low was already created. So this is a pullback, all right? And so the origin of this breakup structure is coming from here. So all the time, if you are looking for the demand zone and supply zone, after determining the demand zone or the supply zone which broke the recent structure, you need to look at the origin, the true guy that had the momentum to do or to violate price by breaking structure. All right, so this guy had the muscle to break structure over here, like I explained when we're doing for demand. So now he becomes the supply. So in future, if price is reversing, we don't anticipate to sell from this guy, but we rather we look at the origin of the guy that truly broke the structure point, because this candle to the downside broke this structure point by body, not by wick. So this truly becomes the supply zone. So we tap into it and then we sell off beautifully. I hope that's understood. Now let's go back to the normal chart and then let's look at inducement. Now, what is inducement? What is inducement? Now, inducement is basically a mechanism that takes place in the market to cause traders to take early trades. Okay, and basically how you can easily spot these on the candlestick chart is the first pullback after a break of structure. So if let me type it so you see, first pullback after the break of structure. Now, what that means is that on an uptrend, if we have this break of structure here and price pullback, but the pullback did not mitigate the structure point that was broken, and then price put in another high like this, if it is coming back, price will now, this low that was put in will now become inducement, and then price will eventually tap into the demand zone and then goes to the upside. Now you realize that most traders who are impatient upon seeing this pullback would enter. Okay, now if they enter from here, where would they put their stop loss? Basically, they are going to put their stop loss around the low, and then price will eventually come and then take them out, tap into the demand zone that is here, and then before going to the upside. So you realize that those that are patient enough will rather be benefited or be rewarded by the market. This is why patience is very key, right? So this becomes the inducement then. This structure point becomes the inducement because that is the first pullback after the break of structure. This is our first pullback. Now, having understand this concept, let's replay this again to see what we are talking about. Now you can see clearly that we had our breakup structure here, like we've pointed out several times. Now after this breakup structure, what happened? Price put in a structure low, price put in a low, and then failed to tap into this demand. So this pullback becomes incomplete. What makes it incomplete is because it did not fill the gap completely. It must fill the imbalance completely, tap into the demand zone, and then continue. But it did not. So making it incomplete simply means the low that was put in becomes inducement. Okay. This low becomes inducement. So what that means that in future, if price is coming, people that took this early buy, putting their stop loss here, will be kicked out. All right. So if this becomes inducement, then this is protecting the demand zone over here. So one way to validate your demand zone or supply zone is that it must always be protected by an inducement. And this is where you determine the inducement. So if price comes back in future, you realize that if we had, you see what happened? You see, price sort of gave a fake reaction to the zone. So if I was not patient enough and I bought from here, putting my stop loss below, okay, because we had what? We had imbalance here as well. So somebody will select this as what? Demand zone, forgetting that this was the main structure point that was broken, making this demand rather valid. And this is an incomplete pullback. So what happened is that price takes the person out and then really taps into the true demand zone that let the main structure point break. All right. If so, you target this high and then if that becomes a clean trade, instead of being impatient taking the trade over here, you rather wait for price to tap into the true demand zone if you are able to determine the correct demand zone and then supply zones correctly. Now, if I flip this chart, it is the same for a sell trade. All right. So after the breakup structure, the first pullback becomes the inducement. We have an imbalance over there. We tap into it and then we push down to the downside successfully. So this video has basically covered everything. I've covered supply and demand. I've covered a bit of structure when we started, and I've also covered inducement. Take your time, watch it over and over and over. Make note, backtest it, backtest the things I've said, and then you start seeing it. And when you start seeing it, you cannot unsee it. You realize that things begin to make perfect sense. So take your time, watch it over and over and over and over. Now, in the next video, I'm going to present two models that you are going to basically trade using this whole strategy or concept, which is structure, supply and demand, and an inducement that I've taught you in these two videos. So if you haven't watched the first video, you'll find the link somewhere up on this video or below the description. Go and watch the first video before you come back to watch this one, because this one covers the two indicators left, supply and demand and inducement. But you need to first understand structure to be able to determine the directionality of the market, and then you now come back to where to engage, which is the location where supply and demand is. And then knowing inducement, you'll be able to select which supply and demand zone are valid, and then you take your trade. So this video basically covers these two things that we've done or we've considered out of this strategy. Now, this trade that we cherry picked, let me use that because it basically didn't cover confirmation. So in the next video, we are going to talk about confirmation. If you are going to trade with limit orders, then you need the confirmation. You just set your limit buy over here. As soon as price get there, your trade is activated and then you are in the trade already. But if you are patient enough, if you are that person that takes extra caution in everything, then you'd want to look for confirmation. So in the next video, I'm going to show you how to confirm your zones before entering the trade. So with that being said, thank you for tuning in. If you haven't subscribed to this channel, please do what to subscribe to this channel. Hit the notification bell. Comment below what you want me to cover in the next video, and then see you in the next video. Peace. My name is TradeMate. See you.